Hello, and welcome back to the Fairfield Financial News Podcast. My name is James Pertinentis, and I'm joined here with my co-hosts,
Andrew Miller
and Jonathan Vicenti.
All right, let's get right into it. Jonathan, give us the market recap.
All right, so as of market close on March 19th, 2024, major stock indices experienced boosts despite lowered expectations for interest rate cuts. This is propelled by notable performances in tech stocks. Alphabet led this charge, with Alphabet's shares surging 5.55% on the week in light of news of a potential collaboration with Apple's iPhone. Additionally, NVIDIA saw a 1.07% increase after unveiling new computing chips, contributing to the tech sector's momentum. The broader market reflected this tech surge, with the S&P 500 gaining 0.56% on the day, the Nasdaq gaining 0.39%, and the Dow Jones gaining 0.83%. And the year-to-date performance of the S&P 500 is 9.9%.
Yeah, so to get into more specific news, let's start with NYCB. We covered NYCB pretty heavily last week, talking about its losses following some commercial real estate losses. And so recently, to sort of combat this, they got $1 billion in capital raised by a group of investors, including Steven Mnuchin, Joseph Otting, Alan Pulowski, and Milton Berlinski. They all joined the board, and Otting will become the CEO, with Danilio, the former interim CEO, becoming a non-executive chairman.
You know, I have to say, I was pretty pessimistic last podcast about NYCB, and I'm sure a lot of people were, but this $1 billion in capital raise really increases my positivity about the company. Another reason why I think there's light at the end of this tunnel is because Mnuchin said that if they ever need more funding, he can get the investors to get them there. So I think that NYCB, while it's going to be a rough road, I think there is light at the end of this tunnel.
Yeah, I would have to agree. I mean, there's some good things happening. They're doing a mortgage tech accelerator, so they're spending money trying to get new technology for their mortgage business. And, I mean, you're not going to do that if you're about to go bankrupt. And also the fact that they just had $1 billion in capital injected shows that the investors really do believe in the business model. I wouldn't be surprised if we see an NYCB sale in the next coming years. I know this group of investors is trying to see a return on their money, and holding NYCB might not be what they're looking for. So I wouldn't be surprised if you saw the value being brought back into NYCB and then a sale being finalized with a bigger bank. I think it's additionally, so just to sort of be a pessimist a little bit, there is this ongoing lawsuit. I think it's being formed at the moment to be filed in the future about the shareholders that lost money on NYCB stock due to the, I don't know if it was lying or just the lack of communication regarding these losses and potential losses from the former CEO. And so I think this could be a major problem for them, especially if they have to give up a lot of their equity and their cash flow on hand to pay off this settlement. But it might be this will be a future problem, as these lawsuits always drag on. So not necessarily that's something to worry about right now, but for future performance, it's important to keep an eye on it.
Do you know how much they want in compensation?
So I think they're still looking to see how many people are interested in joining the lawsuit. So I know they're still in the very beginning stages, but I mean, it's a huge problem that NYCB was able to sort of not be very transparent with this. So I wouldn't be surprised if it was a large amount.
Yeah, that's really a shame. I mean, yeah, man. NYCB, it looks like there's light at the end of the tunnel, but potential danger lingering on the horizon.
I mean, another thing that's pretty important to think about is the amount of institutions that own NYCB stock. I mean, for a long time, it was a very stable stock with a high dividend. So I know there were a lot of pension funds and other institutions that held it. So if these are joining in on this lawsuit, it could be a lot more firepower coming at NYCB. I mean, last time I checked, it's like 77% owned by institutions. So.
Yeah, 69.83% institutional ownership.
Yeah, exactly. So like, there's not just the single individuals that own a couple of shares. There are big holders that are looking to get their money back or get as much equity as they can back.
Mm-hmm. All right, moving on. You guys want to talk about the Reddit IPO?
Yeah. I don't know about Reddit. So in 2021, they're valued at $10 billion in a private funding round. Now they're trying to do their IPO at $6.4 billion. And so there's a couple different perspectives here. On one hand, they're going to grow the community because they're offering 8% of the IPO stocks to users. So these are people like the Wall Street Bets members who are very passionate about the market and who have a ton of influence on the market, as we saw with AMC and GameStop.
And it's also worth noting that these shares are absolved of price locks if you buy in the IPO. And this is for users which have accounts made before this January. And yeah, I believe it's called a price lock. And that essentially states that if you buy at IPO, that you can't sell your shares for, usually it's about like 6 months. So yeah, that's very, very big, giving a lot of leeway to prior users, which is something that they're really, really listing as a big reason for going public.
Me personally, I'm pessimistic on Reddit because, like, just looking back a couple years ago, like Andrew said, they're worth around $10 billion. Now they're IPOing at around $6.4 billion. I mean, to me, it just seems like the owners, the shareholders of this company just want to get out. They want an exit plan now. I mean, they really did grow to a place where, I mean, they already like went past their growth stage. Usually an IPO is to grow a company, to use the funds to create capital, and now they're saying they're going to use some of these funds just to give it to their moderators, which is fine. But I don't see the growth potential in this company.
Yeah, I think it's a mature company, and there's no real room there's no room I can see for innovation. Having used the platform, I really don't see where you're going to be able to pull more money. Maybe a membership fee, something like that. But I think they're going to lose out on some of their loyal users, which are making the whole platform. I think it'd be similar to what happened with X. They tried to, X went from public to private, but this is going from private to public. And I think when you're trying to capitalize on these sort of things, you're going to have a lot of problems with losing out on your user base and increased competition coming in and trying to sort of take over your market share.
Yeah, so I've been a long time Reddit user, and I can really speak to their lack of development in terms of their platform. I don't know when Reddit was established. Let me see.
It was probably around like 10 to 15 years ago.
2009, yeah. So really since 2009, I mean, it has secured a spot within the top 10 most visited sites in the world probably since its inception. And I've been using Reddit for a few years now, and I can really say that, there isn't a lot of development in its model since its inception. So, yeah, I really don't see a lot of potential for growth here. I heard talks of them implementing some sort of AI as a substitute for moderators, but then again, they're listing letting moderators own a share in the business as a reason for why they're going public. And now at the same time, they're having talks about using AI to replace these moderators. I don't know. It just seems like a lot of conflicting information. And like Jimmy said, I feel like it is kind of, showing signs of a company at maturity, and, the founders just want an exit plan pretty much because not a lot of development is happening.
I think another thing about this whole give some value to the moderators, they're not planning on paying a dividend. So it's not like these moderators are going to see a yearly return on their investment to make it worthwhile holding. I think the problem is that you're going to get these moderators a stake in the business, but you're making them pay for it, and you're not going to give them a piece of the business every year. And they said that they're going to use this money, the dividends, potential dividends, to develop the business, but it seems like a pretty mature business to where you don't necessarily need it. And I mean, the new trend with tech companies is that they don't pay dividends. So you don't see, Tesla doesn't pay a dividend because its whole plan is to bring back more money into the business and to grow. So if Reddit starts making growth initiatives, then that'd be great for the business. But if they just continue to basically run it how they're running it, I don't see any real value in the shares.
All right, moving on. Do you guys want to talk about Apple?
Yeah, so Apple just had a announcement of a potential partnership with Google about their AI tech, their models, and potential AI integration into iPhones and Macs. So I think that's really it's a good sign for the company in the sense that they're going to capitalize on this AI and they're going to make the user experience better. But I also see a potential weakness growing where they're looking for a partner for I mean, I'm not positive, but I'm pretty sure it's one of the first times where they're looking to partner with another company for a piece of the business as essential as AI. I mean, usually even looking at any of their products, they don't usually take a partnership to implement a feature. They usually will even prefer being late to a feature instead of implementing. And to partner with Google, a major competitor in both the iPhone market and also in the AI market would be, it seems like it's not Apple, like not very Apple-like to do.
I mean, I agree in the sense that Apple doesn't really partner with, I mean, you can see with literally any product they let out, it's just Apple, their brand, and now they're making this partnership with Google. I think it doesn't show that there's a weakness with Apple, with AI. I think it's just AI is such a big beast that it needs that Apple needs a partner and those relationships to really tackle it. I mean, this is also probably good for Google. I mean, you could flip it around saying that Google needs Apple for certain aspects. I mean, otherwise they wouldn't also do this partnership. So I wouldn't say it's a weakness. I'd say it's going to help both companies tackle this beast.
I mean, definitely. I think it's also maybe that Apple's finally learning from their whole Apple Car disaster, where they were dedicating a lot of money to the Apple Car, and then in the end it didn't work out. And so maybe they figured out that maybe it's just better to make a partnership than to waste all the resources on a piece that is so complex as a self-driving car, the Apple Car. So maybe they just finally learned from that or want to just see the returns immediately.
Mm-hmm. Well, the thing I saw once they announced that they were giving up on the Apple electric car was that they were moving all the employees that they could to generative AI efforts. So there's a lot of different generative AIs. Gemini in specific is a MLLM, which stands for Multimodal Large Language Model. And yeah, I mean, like Jimmy said, this is very, very out of character for Apple to partner with a competitor for something as important nowadays in products as generative AI. So, I mean, I don't know. I feel like this could really, we were talking about this earlier. I feel like this could really speak to Apple potentially struggling in this area. But I feel like it could also show that Apple, in the past hasn't really been afraid of being late to the party. And I feel like maybe in that meantime of them developing this generative AI of theirs, they're just using Gemini, attempting to license it for their products in an attempt to fill this gap in that meantime.
Well, something that Apple is known for doing is taking a product that another company has already made and just making it better. So, like with computers, with phones, cell phones, they've done this. I mean, even now with the Vision Pro, you can see that after Meta, and they're trying to make these products better. I mean, a lot of these companies, these big companies like Google, we've seen beta versions of their AI, like the Bard and all that. But I think that all these companies, they have a horizon where they want to reach, and that prototype hasn't really been made yet, So I think everyone's just kind of shooting in the air with these products, but Apple just really, I think everyone's just trying to figure out how to make the best product. But it's difficult because it's just the perfect product isn't out there to be based off of yet.
Yeah, I mean, I think another thing is there's like a lot of liability surrounding AI. I mean, giving misinformation, all these other problems that come with a model that learns from other things, doesn't make its own opinions, doesn't have any sort of baseline sort of instincts. It can only do what you teach it. And so there are problems regarding this, where AI models tell false information. So Apple might also even just be avoiding liability. All right, and then so I think next we can talk about NVIDIA. We talked about this a lot in our last episode, but they just had their big tech keynote, and so they sold out, I think, 11,000 seat arena for Jensen Huang's speech.
And just to put that into perspective, the iPhone 15 launch had, I think, it was less than 1,000 people.
Yeah, I mean, that shows just how much people are paying attention to NVIDIA right now.
Yeah, this guy's a rock star.
And so it just announced a new Blackwell GPU architecture. So it's double the size of the H100, which is the current AI leading chip. And it's expected to deliver 4 times faster training and 30 times faster inference. So, I mean, this is going to be a massively powerful chip. We don't know about the price or how much production they're going to have or be able to have. But, I mean, it's honestly shocking that they're able to make this much progress and this quick. And it says a lot about NVIDIA as a company where it's making a ton of progress. So NVIDIA is already up 80% this year, over 80%, and 240% in the last year alone.
Wow.
So, I mean, I don't know if they're expecting this kind of product to be produced and we're expecting to be announced. But, I mean, if not, I can see the share price growing rapidly following the launch.
Yeah.
Yeah,
I mean, I think this is priced in ahead of time. Yeah. We've known about this event. This event has been, going on for the past few years. In the past, it's been held on Zoom, actually. So this is the first, real big one. And, yeah, I mean, I feel like this was already priced in. I mean, there was already talks about a new chip being developed for this. So, yeah, I feel like this was already priced in ahead of time. It doesn't downplay its impact on the AI sector.
Yeah, I mean, I think NVIDIA is going to continue to be an industry leader. The fact that they're able to get 2 times the chip size and 30 times faster inference just shows how much progress is happening. I mean, I don't know about you guys, but when I'm using AI sort of technologies, I'm shocked by how fast they are. I mean, sometimes even when you see delays in them, it's not substantial and it's still pretty quick. And so the fact that they're going to be this much faster necessarily just shows how much growth we're going to see in the future for these technologies and that we're just seeing the forefront.
Yeah, man. Yeah. Very exciting.
Excited to see what's to come.
Exciting for my portfolio.
All right. So do you guys want to – so actually I want to come back to what we said last episode, what I said about EVs and hybrids. So I saw an article from the Wall Street Journal talking about how hybrid sales are surging while EV shoppers are hesitating. In Toyota in particular, which is one of the leading brands for both hybrids, definitely, and they also have a bunch of EV models. And so the average time to get a car off the lot for hybrids is much faster, even though it is a very hot car market right now. But hybrids are much faster coming off the lot than these EVs are.
Well, I think that the hybrid market is not something to downplay. I think that everyone's trying to put in, electric vehicles is what we should transition to straight from, propane gas cars. But I think that, hybrid is a good in between, because a huge issue with electric vehicles is, the battery life. And with hybrid cars, it kind of eliminates that issue. Yeah, it's better for the environment, but you don't need to charge it all the time. It can also take gas, which is best of both worlds, in my opinion.
Yeah, I mean, I think that's the point I tried to make last week. And then just looking at the numbers right now, a hybrid, the average time off a lot has been lower the whole time, but it's 25 days to get off the lot. And then gasoline cars, 51, plug-in hybrid, 65, and so are EVs at 60. EVs are 67. So it really shows that this demand is great. I mean, my dad bought a plug-in hybrid from Toyota the other 2 or 3 years back, and he literally couldn't pick out anything. They had one on the lot or coming in, and he just had to buy it on the spot.
Wow.
The demand is there. I mean, the demand is there for all cars right now. It still is a hot market, but, I mean, it definitely shows how much people are valuing this sort of hybrid because it also is cheaper than these EVs.
Yeah, going off that demand for EVs, did you guys hear that Tesla is set to increase prices in Europe? So yeah. Yeah, Tesla is they dropped prices, I want to say late last year as a means to stimulate demand, but they didn't see an increase in demand, so yeah, they're bumping these prices up. I think by 1,000. This is only for the Model Y. But it's 1,000 in the U.S., 2,000 euros in Europe.
So, do you think this is a change in, or a difference in the style of car preferred by different markets? Because I know in Europe particularly, I did a presentation on Genesis. So like we sort of talked about how there's differences in the preferences of different markets. So Europe usually prefers more compact cars. They want something like a Mini Cooper, that kind of car where it's nice and short, can park on streets, pretty efficient. Teslas are usually long, big cars. Do you think is that impacting it?
So this is specifically for the Model Y, and the Model Y is a pretty average sized car. So I don't know if that's necessarily a factor. I mean, like, look, yeah, it's a pretty average sized car. It's like, you know.
Well, I mean, I just compared to like the
Jonathan, you're saying they increased in Europe $1,000 more than they did in the U.S.
2,000 euros in Europe and $1,000 in the U.S.
So I think part of that, I don't know, I could be wrong. Part of it is probably because electric vehicles are more popular in Europe, so the demand is probably better in Europe than it is in the U.S.
Yeah, I mean, I think it's just notable because Tesla's really been, in terms of their pricing, it's been on the downtrend, pretty much since its inception. I mean, its whole thing is making electric cars more affordable. So this is really the first like big price increase that we've seen in a big minute for Tesla.
I mean, like last year when they cut these prices, it reflected on the stock price. That demand did not catch up with those price cuts. And I think Tesla is kind of backing on their tracks, trying to figure out what to do now to bring back up that stock price, and a big part of that is probably increasing prices again.
Yeah. Well, I also think they could really, they have a lot of leeway to do that with the rising, incentives to buy electric vehicles. I believe especially in Europe, there's more incentives, like in terms of like, what is it called? Subsidies?
Subsidies.
Yeah.
I mean, I think another thing about Tesla is that I really do think that they're seeing a ton more competition right now. Their build quality is finally catching up to them as people have more options to where to buy. And, I mean, in Europe, I'm sure there are European cars that aren't in the U.S., so the competition is probably just as great there. So I don't know if necessarily the problem is the price or if it's just the product that they're giving the consumers.
Yeah, I don't know, but it's going to be interesting to see what they do in the future.
So the Federal Open Market Committee.
Ooh,
so
the Fed.
They are meeting tomorrow at 2 p.m. And so we're going to see if they're going to cut rates, hold rates, or increase rates.
Do you guys want to play like 7-Up and, like raise your hand if you think they're going to cut rates?
They can't really see our hands there.
Yeah, okay.
All right. Say aye if they're going to cut rates.
Yeah, so, I mean.
Say aye if absolutely nothing's going to happen.
Aye.
Aye.
Increase rates.
Oh.
Do you really think they're going to
Come
increase
on.
rates?
Get out of here, bro.
Hell yeah, brother.
I mean, I it's actually interesting because I was in my finance class. We were talking about how my professor was talking about he could see potentially a rise in rates, but he was also saying that if a rise in rates happened, the market is not going to know what to do with itself.
It's going to implode.
For this meeting, I think it's pretty universally agreed upon that they're going to hold the rates, and people are saying the first rate cut is probably going to happen in June. Really, who knows? The market isn't reacting how they thought it would this year. I mean, a lot of people thought there was going to be a recession this year. That's seeming to cool down. I mean, I read somewhere that there was like a survey done, and only 33% of respondents thought there would still be a recession this year, even though it was pretty much seen as like a guarantee last year, at the end of last year. So, I mean, I think this meeting is going to be huge if they don't hold rates. But if they do, I don't expect much happening to the market.
I mean, on a serious note, like I think in the next coming months, they're going to end up cutting rates, especially with the elections coming up. I mean, right now, I think that they probably are just going to hold the rates and keep everything the way it is now.
Yeah, I think we're setting up for a nice and comfortable soft landing, guys. But, I would expect only like a few rate cuts this year, like max 4.
I really think I could see like 2 to 3 rate cuts this year. Jerome Powell is still the most important man in the economy. If he holds but has some remarks that are not confident in the economy, I think the market's going to drop. If he holds and has some remarks that are really good for the economy, I think the market will rally. I also think that he knows how influential this election is going to be. So I think he'll do things to soften the blows. Maybe that is cutting rates even when he wouldn't normally, just to make sure that the economy or the election has a little bit of less impact on the market. But who knows? I think Jerome Powell will hopefully do the right thing, but we'll see, I guess.
I think he's done a good job so far, though.
Yeah, he really has strengthened the economy.
I mean, the inflation was bad, but I think he did get it under control, even though he probably should have raised rates a little earlier.
I mean, when's the last time we've seen a soft landing? Good job, Dr. J.
Definitely not Spirit Airlines.
Jimmy knows that firsthand. So do you want to talk about FedEx quick, or?
All right, yeah, so FedEx, I've had a lot to say about this. FedEx is trying its absolute hardest to be seen as a tech stock. It's saying its reasons for this are that it has a lot of business intelligence models in place in a lot of their facilities, which, one, collected a lot of data, but two, optimize their business operations a lot.
Yeah, I mean, even if you look at their recent acquisitions, which aren't recent, but they bought ShopRunner, an e-commerce platform that connects brands and merchants with online shoppers. So their whole thing is that they're trying to make it a suite of sort of online businesses. So you have the shipping, sort of all these other business solutions all in one place. And I mean, honestly, if you really think about it, that is the best model for them because they are making all their money off these online businesses. So if they can sort of give them more value to their brand and to staying with them, they're going to be able to keep these customers coming back.
I mean, this is not specific to just FedEx, but I think there's a trend now that a lot of companies are trying to identify themselves as tech companies.
Mm-hmm.
And I think there is a lot of merit to FedEx. I don't think they're trying to, do something that they're not. But also identifying as a tech company, what that does is it gives you a higher valuation because in terms of if you ever want to sell the company, you could probably sell it for more money if it's a tech company because of the potential growth. And this can range from like 8x to 15x earnings,
Yeah, and additionally, Lidl, I saw. Lidl, I don't know if you guys know, it's like a big grocery store in like Europe.
Yeah.
Started in Germany. Yeah, there's one. There's a couple on Long Island.
Yeah,
I know. Yeah.
One right in Comac.
I think is it Lidl or Lidl? I don't know.
I say Lidl.
Yeah, I say Lidl. Yeah, I saw that Lidl also was doing a lot of the same thing where they have a lot of business intelligence models in place. And yeah, they're really, one, they're selling that data, using it to optimize their business operations. And yeah, I think, like Jimmy said, the real incentive for a lot of companies doing this is, increased valuation of them. We've seen tech stocks in the past forever. Just, always leading the market, man. So,
Forever.
In the past, forever. Yeah.
Yeah, I mean, even look at any of these grocery stores. I think it's big that they're trying to increase their valuation, but I think it's also all about utilizing this technology to really maximize their business efficiency. I mean, with Lidl, they're using this to.
Sorry, not to cut you off. I think that's where the merit comes from in terms of valuation.
I mean, yeah, that's exactly what I'm saying, though. But, it's not like it's, greenwashing where they're just trying to say stuff to make it sound better. They really are using this technology, and this valuation is becoming valid for these businesses to be more profitable.
Yeah, I mean, I'm not saying that they're just saying it just so they can get a better valuation. I'm saying they're actively trying to transition from a grocery store to a more tech-oriented company to, increase the valuation, as an incentive, probably.
Yeah, I mean, it's really awesome to see how these sort of companies are implementing new strategies to grow and to be more efficient.
All right. Well, thank you guys for listening to this week's episode. Really appreciate you guys for tuning in this long. And yeah, we're going to try to get more episodes out for you guys. Maybe, shooting for one a week with only a day delay. So yeah, until the next episode. Thank you guys.